Viewers at home, you are welcome to my presentation on business valuation. In this presentation, I will explain the meaning of business valuation, reasons for valuing business, methods of valuing business, and I will equally solve comprehensive work examples. So what do we mean by business valuation? Valuation of business is the determination of net worth of business. The determination of net worth of business is said to be the business valuation. The net worth of business are its equity. The net worth of business are its equity. Equity is the total assets less liabilities. Total assets less liabilities. That is equity. Therefore, to value business is to determine the worth of its equity. To determine the worth of its equity. That is valuation of business. Reasons for valuing businesses. Reasons for valuing businesses. Number one, for the scheme of merger. For the scheme of merger. Two, for takeover bid. For takeover bid. Three, when unquoted companies going public. When unquoted companies going public. Number four, during sale of shares. During sale of shares. Number five, when shares are pledged as collateral for a loan by unquoted companies. When shares are pledged as collateral for a loan by unquoted companies. That is, those are the reasons for valuing businesses. So we want to consider methods of valuing business. Methods of valuing businesses. Methods of business valuation. Methods of business valuation. Methods of business valuation. Number one method is basically there are three methods of valuing business. There are three methods of valuing business. Number one method is asset-based method. Asset-based method. Number one is asset-based method. Under asset-based method, we will consider the book value. Book value. Number two, we will consider realizable value. Realizable value. Number three, we will look at the replacement value. Then we have intangible. These are methods we are going to consider under asset-based method of valuing business. Number two method is market-based method. Market-based method. Market-based method. Under this method, we will consider market capitalization. Market capitalization. We will as well consider price earning method. Price earning method. Then we will as well examine the market to book ratio. Market to book ratio. That is under market-based method. Then the third method is cash-based method. Cash-based method. Cash-based method. Cash, that is number 3. Cash-based method. Under this method, we will consider dividend valuation model. Dividend valuation model. Then we will also consider free cash flow. Free cash flows. Then we will as well consider the discounted cash flows method or techniques. Discounted cash flows techniques. Then we will as well consider the economic value added, EVA. We will as well consider EVA. Then finally, we will as well consider adjusted present value. So these are the methods we are going to consider under this. So we want to start with asset-based method of valuing business. Asset-based method. That is the first method we are going to start with. Asset-based method. Asset-based method. Under this method, the value of the business is total assets, excluding the intangible assets, less total liabilities. Asset-based method consider the total of all the assets, excluding the intangible assets, unless it has a market value, less total liabilities. That is asset-based method of valuing business. The second method I mentioned is market-based method. Market-based method. Market-based method uses market information. This method uses market information such as the share price, price earning ratios, etc. to value the business where efficient market exists. So market-based method uses the market information such as the share price, the price earning ratios, and so on. So when efficient markets do exist. The third method is cash-based method. Cash-based method. Cash-based method. Under this method, the value of the business is the present value of the future cash flows. The present value of the future cash flows. That is cash-based method. So now we want to start with the asset-based method proper. Asset-based method of valuing business. Under the asset-based method, I've told you that the asset-based method, we said this method value the business by deducting all liabilities from the value of the assets as per the statement of financial position. You deduct the liabilities from the total value of the asset in the statement of financial position. That is asset-based method. So under this asset-based method, we are going to consider 1. The book value. 2. We will consider replacement cost. 3. We will consider net realizable value, and the last one we will consider intangible assets. assets. So these are the methods we are going to consider under this method. So we are starting with the first one, book value. Book value. Book value. This method involves the use of the total value of the tangible assets as per the statement of financial position. We said it involves the use of the total value of the tangible assets as per the statement of financial position less all liabilities. Intangible assets are excluded. Intangible assets are excluded unless they have a market value. Where an intangible asset has a market value, then that means the market value of the intangible asset will be considered. So apart from that, you are going to exclude the intangible assets such as goodwill when applying this method in valuing business. So we are on the book value method of valuing business. Book value method. So valuation of the business. Valuation of business using the book value approach. You are going to start with the non-current assets. Non-current assets. The book value of non-current assets. By book value, we mean the value as per the statement of financial position. Then we also consider the current assets. Current assets at book value. Book value, that is the value as per the statement of financial position. When you add it, you have the total assets. Total assets at book value. From this total assets, you less liabilities. You less all the liabilities. You less all the liabilities. So when you less the liabilities, you get the value of equity. Value of equity. Then you now have number of issue ordinary shares. Ordinary shares. Maybe you issue X ordinary shares. When you divide the value of equity by the number of issue ordinary shares, then you get value per share. Value per share, which will be maybe $1 or $0.08, or it may be in naira or kobo. So that is value of the business using the book value approach or method. The second method we are going to consider now is the replacement cost method. Replacement cost. Replacement cost method. Replacement cost method. So that is under asset-based method of valuing business. The value of the business is the net asset at their cost of acquisition in the open market. That is the value at which the asset will be bought currently in the open market, less all liabilities. The value of the business is the net assets at their current cost of acquisition in the open market, less all liabilities. I've told you that the cost in the open market means the value at which the asset could be bought or sold currently in the open market, that is at an arm's length. So under this method, valuation of business using replacement cost. You start with non-current assets. Non-current assets at their replacement price. Replacement price. Then we also have current assets at their replacement price. When you sum it up, you have the total assets. Now let's all liabilities. The amount to be paid. It's what we are going to consider here. The amount to be paid for those liabilities. So when you deduct that, then you get the value of equity. Then from that, then you now have number of issue ordinary shares. Number of issue ordinary shares. It could be X shares. So when you divide this by this, then you get the value per share. Value per share. It could be B dollar or B cent. So I want you to take note of this. Where the replacement value of an asset is not given, the book value should be used. Where the replacement value or replacement price of an asset, where it is not given, then you use the book value. The book value should be taken as the approximation of the replacement price, where the replacement price of an asset is not given. The third method I'm going to consider is net realizable value. Net realizable value. The word realize means to sell. Realize means to sell. Under this method, the market estimate of the asset should be used in determining the value of the business. You use the market estimate, that is the estimated realizable value. That is the amount you can realize from the asset. If these assets are sold, then that is the value to consider. This method is suitable for business, for valuing business that is going on liquidation. It's suitable for valuing business that is going on liquidation. So, under net realizable value method, the value of the business, valuation of business under the net realizable value, you are going to start with non-current assets. Non-current assets. You are going to use the market value. Market value of the non-current asset. By market value, we mean the amount at which those assets could be sold. Then we also have the current assets. If you don't want to call it market value, say at their realizable value. Realizable value. The amount at which they could be sold. So, the current assets, then you have the total assets. Then from this, you less all liabilities. Liabilities will be included at the amount that will be paid for those liabilities. Then you now have value of equity. Value of equity. Then you now have number of issue ordinary share. Number of issue ordinary shares, that could be X shares. Then you have value per share. Value per share. That could be C dollar or C cent. So that is for that. So in an examination where the realizable value of an asset is not given, where the realizable value or the market value of an asset, where it is not given, the book value should be used. Where the realizable value of an asset is not given, the book value should be used. So I want to take question as work example. I want to take question as work example. Example 1. The summarized statement of financial position of ABC PLC as at 31st December 22x is as follows. You are given assets, then you have non-current assets, and that is 600,000. We have current assets, which include inventories of 500,000. Inventories 500,000. Then we have receivables 700,000. We have bank balance 150,000. Current asset totaled 1,350,000. Then the total asset, that is current and non-current, is 1,950,000. Then we have equity and liabilities. We have capital and reserves. Capital and reserves. $1 ordinary shares 650,000. Retained earnings 400,000. Total equity 1,050,000. Current liabilities. We have trade payables 550,000. Bank overdraft 350,000. Current liability totaled 900,000. Then you have total equity and liabilities 1,950,000. The following additional information is available. 1. There have been no changes in the issue ordinary share capital since incorporation of ABC PLC. 2. The estimated value of non-current assets are inventories of ABC PLC, of non-current assets and inventories of ABC PLC as at 31st December 22x, where you are given their estimated value. Then you have the replacement price. The replacement price is given, then the realizable value is equally given. We have non-current assets. Non-current assets 650,000, that is their replacement cost. The realizable value is 400,000. Then we have inventories 600,000 as the replacement cost, and the realizable value is 350,000. Note 3. 10% of the receivables as at December 31st 22x are irrecoverable. Required. Determine the value of ABC PLC as at 31st December 22x using 1. Net asset basis. 2. Replacement cost basis. 3. Realizable value basis. Now, you want to solve the question. We have solution. So, the first one, you have 1, you have 2, and 3. Let me say valuation ABC PLC or valuation of ABC PLC. Valuation of ABC PLC. We have 1, 2, and 3. Under 1, you have to use net asset basis. Net asset basis. That is for number 1. Net assets basis. The currency is in dollar. 2, you have to use replacement cost basis. Replacement cost basis. We have replacement cost basis, and the currency is dollar. The third one is realizable value basis. Realizable value basis. So I've told you that to value business using this method, you start with non-current assets. Non-current assets. Non-current assets. Non-current assets. So you are given the replacement cost. Non-current assets. Replacement cost is 650,000. You put that 650,000 under the replacement cost. So 650,000. Then the realizable value of non-current assets is 400,000. You put that under the realizable value. 400,000. 400,000. Then we have inventories. Inventories. The replacement cost of inventory is 600,000. The replacement cost is 600,000. You put that under the replacement cost. And the realizable value of inventory is 350,000. You put that 350,000 under the realizable value. 350,000. So note 3, you were told that 10% of the receivables as at 31st December 2022 are irrecoverable. That is irrecoverable. Now let's go back to the statement of financial position we are given. So you have non-current assets. Non-current asset, that is 600,000. That is the book value of the non-current asset. You put that under net asset basis. You put that under the net asset basis. So, and that is 600,000. 600,000. Then you also have inventories. Inventories, and that is the book value is 500,000. You put the 500,000 under the book value of inventory. 500,000. Then you also have receivables. Receivables is 700,000. Receivables. That is 700,000. That is the book value. You are not given the replacement cost of receivables. You are not given the replacement cost of receivables, but you were told that 10% of the receivables as at 31st December 2022 are irrecoverable. The essence of this is to get the realizable value. If 10% are irrecoverable, that means the amount that will be recovered will represent the realizable value of the receivables. So, since the replacement cost of receivable is not given, that means the replacement cost will be the book value, which is 700,000. I've told you that where the replacement cost is not given, the book value should be used. But for the realizable value, Then you were told that 10% of the receivables are irrecoverable. If 10% of 700,000, which is the book value, and that will be 70,000. If you subtract that 70,000 represent the irrecoverable debt, that is the bad debt. 10%, 10 over 100 times 700,000. That will represent the bad debts. So, if you now subtract the bad debts of 70,000, the bad debts of 70,000 from 700,000, then you'll be left with 630,000. 630,000. The 630,000 represents the realizable value of the receivables. It represents the realizable value of the receivables. Then we also have bank balance. Bank balance, and that is bank balance of 150,000. Bank balance of 150,000. Bank balance of 150,000. You put bank balance, and that is 150,000. The replacement value will also be 150,000, and same as the realizable value. So that is all about the assets. You now sum up the assets. 600,000 plus 500,000, that will be 1.1 million, plus 700,000 plus 150,000, and then you have 1,950,000. Then for the placement cost, you have 650,000 plus 600,000 plus 700,000 plus 150,000. There you have 2.1 million. For realizable value, we have 400,000 plus 350,000 plus 630,000 plus 150,000. Then you have the total of 1,530,000. These are the total assets. I've told you that from the total assets, you less liabilities. From the total assets, you less liabilities. Our liabilities include trade payables of 550,000. Trade payables of 550,000. Then and the bank overdraft of 350,000. Those are the two liabilities we have. Trade payable 550,000. The bank overdraft of 350,000. Those are the liabilities we have. So now you want to less the liabilities. So liabilities include trade payables of 550,000 and 550,000. Then we also have bank overdraft. Bank overdraft of 350,000. 350,000. 350,000. Those are the only liabilities we have. When you less the liabilities from the total asset, then you have the value of equity. So let's subtract the liability from the total asset. Then this one, we have value of equity. This will be 1,050,000. The total liability is 900,000. If you subtract it from 1,950,000, you'll be left with 1,050,000. Then 2.1 million minus 900,000. Then you have 1.2 million under the replacement cost. Then under the realizable value, 1,530,000 minus 900,000. Then you'll be left with 630,000. 630,000. That is the value of equity. Then after this, you have number of EU shares. Number of EU ordinary shares. Number of EU ordinary shares. You go back to the equity section of the statement of financial position. The equity section, you have $1 ordinary shares, which is 650,000. If you have 650,000 divided by $1, it will still remain at 650,000. Therefore, the number of EU ordinary share will be 650,000. 650,000. 650,000. If you now divide the value of equity by the number of EU ordinary shares, value of equity by number of EU ordinary shares, you have 1,050,000 divided by 650,000, and that will give us $1.62. That is value per share. This is the market value, $1.62. Then 1.2 million divided by 650,000. This will give us $1.85. $1.85. Then we also have 630,000 divided by 650,000, and that will give us $0.97. $0.97. That is the value of the firm using the three methods I've explained. That is using the replacement, the net asset basis, using the net asset basis, replacement cost basis, and realizable value basis. Please subscribe to keep up with my upcoming lecture. My next lecture shall cover the market-based method and cash-based method of valuing business.